Good afternoon, everyone. Today is Friday, the 7th of September, 2012, and this is Brian Shannon speaking from alphatrends.net. We're taking a look at the SPY on the chart right now, and obviously we broke some resistance this week and had a real strong performance here the last 2 days. It looked like the market was going to do a whole bunch of nothing, but we did end up with a 2.2% gain for the SPY on the week. The Nasdaq up 1.6%, and that Russell 2000 we've been talking about with the inverted head and shoulders pattern is outperforming as we thought it would, now up 3.8% for the week, and almost caught up with the S&P 500 year to date. The laggard was the semiconductors, but they did make a real strong recovery on Thursday, and looks like the worst is behind for them. Financials had a great week also, and as did gold. So let's take a look at the action here. The S&P 500, as we noted on Wednesday, was still in a primary uptrend, and it just seemed as though maybe a whole bunch of nothing was going to occur as this support held between that 140 to 140 and a quarter level. It just seemed as though we were going to maybe grind around in this range with the resistance up at 142.10, but of course we had that gap higher on Thursday, and as that gap came, I had noted on a blog post that these gaps higher above a 5-day moving average after being below have been very good with follow through. So if we take a look at yesterday's action, this is where we gapped up to and then ran. This was the volume weighted average price for yesterday. We hung out right there a little bit and then continued to ramp higher. Now these are the pivot levels from today, so just ignore those. But we had stayed above the volume weighted average price for yesterday. So this is the average price of the last 2 days. The volume weighted average price for the week now at 142.10, right about that level that we were looking for the market to break beyond. So we have obviously multi-year highs here for the S&P 500. We haven't been to these levels since 2008. Obviously the Nasdaq even stronger than that. But you look at this market and you say, where are the potential levels of resistance? Well, maybe this area right here or just a little bit above. Rather than focusing on price targets and realize, trying to figure out if the market's too extended and that sort of thing, you don't want to be a short seller into this type of strength, because these rallies can continue for longer than a lot of people expect, and you're going to have to withstand a lot of heat if you're taking that short, and eventually you might get squeezed out on one of those little spikes higher. Instead, we want to be aware again of the definition of trend, which is higher highs and higher lows. So if we look at it that way, we could say if you're long, raise your stop up to 133.90, or if you're in cash, wait for the pullback at this point, or maybe you get involved in it as it's breaking some intraday resistance, like right here, even just at the end of the day, with a stop a reasonable distance away. But you have to realize that when the market gets this extended up for 3.5 points basically in the last 2 days, that the odds of a pullback would become greater. So you want to have a little bit less share size on and reduce risk that way. So a lot of people, I think, felt left out of this market's rally, but it did give us good clues that it was going to get going as the primary trend did remain higher. As I'd mentioned, though, that the semiconductors were really our main reason for concern this week. They did come down and touch almost perfectly upon that 50-day moving average. As I always say, I don't think it's a good place to buy just because it's testing a 50-day moving average, but it turned out to be a great place to buy in the semiconductors. As Thursday we were up 3.5% or so, and the good thing about this is, even though it was down just about 1% today, it got extended yesterday, and then I was talking to subscribers today that we wanted to see at least hold the 5-day moving average today, that a pullback wouldn't be a bad thing for it, as it did get a little bit extended here. By the way, this is Realtick that we're looking at. Realtick is the provider of the charts and trading platform that I use, and all of these all the different time frames of technical analysis we're looking at. So check out realtick.com. I've been using them for a decade or so. The semiconductors, since we're on them, let's just next week we want to see probably about $32.70 hold in the semiconductors. If they can hold and kind of build a little bit better base in here, turn sideways for a day or two, then I think that by the end of the week we could see a push beyond yesterday's high at about 30. 33 and a quarter and resume this bullishness that was unfolding here and continue to move higher in the semiconductors. The Nasdaq was down 10 cents today, but obviously, again, for the week, it had a nice performance, up 1.8%, and we did break this resistance level. Similar situation to the S&P 500 is that we were looking for the 67 to 67 and a half level, that is this band of support, to hold. We had a pretty good little scare actually on Tuesday, as the market came in pretty hard early in the morning, but it recovered nicely, and again, that gap higher really brought about a continuation of the upside on the daily and the weekly and on the monthly time frame, up to levels not seen since, let's just turn a horizontal line and say that maybe the next important level is 73ish. It doesn't look like it has a lot of natural supply, meaning people who a big source of supply that is a prior big area of support. So for instance, we were looking at this support in here as potential resistance a couple months ago because there's price memory from there. We don't have that price memory now. It's just a pattern of higher highs and higher lows. So we want to listen to the market and the definition of trend, which is obviously higher highs and higher lows. So if we break today's lows, if we break that 2-day volume weighted average price right here, I'd say probably about back below 69.20. I think we want to get a little bit defensive early next week because perhaps we would see it pull back down towards 68.60, and that wouldn't be a bad thing. We would just be establishing a new higher low at a prior level of resistance. So that resistance we would expect would become support if it were to pull back, and we'll see this rising 5-day moving average catch up to price as it pulls back as well. So those are some clues to look for next week. The Russell 2000 again was the clear winner this week, up 3.8%. And we've been talking about this inverted head and shoulders pattern. I said that I prefer to look at it that way than the horizontal resistance at 83, but we blasted past 83 as well, and then up to the or close to the next potential level of resistance, which we see is the highs for the year, and that's just at about $85 a share, so just below 85. Looking at the weekly time frame, then we have last year's highs up near about 87.5. What we were talking about though is we've been talking about for the last couple of weeks in the Russell 2000 is on the weekly time frame. We have this left shoulder, we have a head, and we have a right shoulder. It looks like we've broken the neckline there. Now, to come up with a price target would be approximately, very conservatively measured, 65 up to the neckline here of 85. So we would add that to this break of 82. So we'd be looking at 20 points or about 102. Now, I think that's a little bit crazy to be looking for a price objective of 102, and especially with last year at 85 or 87 being the all-time high. Even the price objective of the inverted head and shoulders on the daily pattern, I think, is maybe a little bit aggressive, but we could take a look at that basically from 82 down to the bottom of the head of 73. That's 9 points, and if we add that to the breakout point of about 81, that would give us a price objective of 90, and perhaps we see 90, but I can guarantee you this: we're not going to go straight up to 90. Instead, we're going to see some action that might look like this, and then even sideways corrections, and then the next leg higher until it gets up to that level. The name of the game always is risk management, and you have to ask yourself, where has it come from? It's just come from a test of this 80.5 level to 84.5 basically here over the last couple days. So about a 4 or 5% rally, which is a nice move. And now we're going to look at it and say, well, it's still innocent till proven guilty because it's in an uptrend on all these time frames, and especially on the shorter time frame here, this 10-minute, that we would be looking for it to be able to continue to move higher, because again, that's the path of least resistance, and we don't want to be selling short. I think that a lot of people tend to sell short up in here. The market turns sideways, the 5-day moving average catches up to it, then it takes off again, is what it seems to be doing. The financials had a great week, and they did exactly what they were supposed to do. We've been talking about this $15.20 level that when it broke, it looked like it was ready for a quick move up to $15.50. That was the first potential level of resistance. We had a break late or early in the day on Wednesday. It didn't create a lower low after that break of $15.20, and on Thursday obviously we had the gap higher and continuation of that move. Now, as I was telling subscribers yesterday, just because we're at 15 and a half, and that's a level we had previously identified as a potential resistance level, rather, doesn't mean that we need to sell our positions or look to sell short. That the momentum is higher, that we have strong momentum. We have a breakout move in a group where in a market and in a group where the energy has been contracting and building here. We had a nice break a couple weeks ago, about a month ago. It consolidated through time. The energy built, it broke out, and continued nicely higher. So the point of potential resistance levels is just that, just to say, hey, does it look like there's the opportunity here to am I taking too much risk relative to the perceived reward? And it really got past the next level, and now looking at a weekly time frame, 16 looks like the bigger level where it has the potential to slow down. But then you look at that weekly time frame of the last year and a half, and it looks like a big cup and handle as well. So the financials have a lot of momentum in them right now. This prior level, though, at 16 did show some support, which has turned into resistance. So that looks like a potential likely battleground, but it doesn't mean the market is going to run up to there and then you can short it safely and it's just going to cave in. More likely, it's going to pull back and make a series of higher highs and higher lows instead, or consolidate through time, maybe a shallow price movement. But the primary trend is higher, and that's the trend. If you're going to fight that trend, you only do it for very brief periods of time when the intraday momentum tells us that. And even today, we were above the volume weighted average price the entire session, making it, and the VWAP was also rising, and that makes it a high risk short if that's what you're looking if that's the type of trade you're looking for, is what I meant to say. Taking a look at a couple of stocks here, Apple is I believe it closed at an all-time high. It looks like it did, all-time closing high. So the momentum remains strong, and a lot of people are calling this overdone and overbought and that sort of thing, and due to crash. But the momentum is higher. It's higher highs and higher lows. We broke some resistance here on Thursday, and just a nice pattern of higher highs and higher lows with a rising 5-day moving average. It's anyone's guess how high Apple can go, but the momentum is higher, and I really think only a fool buys it. It was disappointing, the action in AIG this week. I had written this up on alphatrends.net, and if you're looking at YouTube, go to alphatrends.net and see some of the other stuff that I do. But AIG looked like it had the potential to really be a good breakout candidate beyond 35. It got beyond 35. I guess that was on early in the week. Then we saw a pullback, and I was looking to buy it on this day right here, back above 35.03, and then it gapped down on Thursday. Had a real wild day, so there's just too much volatility in there for me. But I was liking it because of this this cup and handle on the weekly time frame, and it seemed as though the energy was just building. Now it's not completely broken; it's back into this range, but the stock is just too back and forth, too volatile, too choppy in here for my liking. So it's not one that I'm going to continue to take a look at. Amazon continues to power higher, and this one is up at all-time highs. GE continues to break out. Google, we had noted the breakout in here a few weeks back. It's had very shallow pullbacks. Google has. It's been riding the 10, then the 20-day moving average, and it really just corrects slightly through time. And it looks like, with Google at all-time highs, or I'm sorry, it's not all-time highs, that it should at least test the 750 level. I still say that it looks like it's headed for $800 a share, and even possibly by the end of the year. But you can't get overwhelmed by a price target. You have to look at it and say what's most likely. Gold had a great continuation. I was not expecting this, and we spoke about this last week, that I thought maybe we would consolidate above that 200-day moving average for a bit and pull back. I was not expecting it to rally like this, but you can see same thing in here, is that when this stock when the GLD got back above that 5-day moving moving average, it really took off and extended its move higher. Now looking at a weekly time frame, gold could be headed for 175 here with the GLD before it's done. Silver also continued to add to its big breakout that occurred just a couple days before gold did, and it was halted at its 200-day moving average for a bit, and I'm sure some people sold short right in here. Well, from this failed break lower came that fast move higher, and the problem was the daily time frame is still higher. Some people were looking at the 200-day and saying, well, I got to short it there, it's breaking back below the 200, but we barely tested that 10-day moving average and rocketed higher. So the path of least resistance for the metals remains higher. Microsoft was another disappointing stock. Really took off yesterday, and I had written about this one for that Traders Planet article. It still looks like it's got some room to run. I mean, it's Microsoft. It got extended. It's pulled back to the rising 5-day moving average. I would say if you're in this one, a stop should go at about $30.60. The U.S. dollar got hit hard this week, and that's this trend line was broken. So that's a trend line that's been in play for the last year and a half, 2 years. It looks like the U.S. dollar index is headed to 2180, and then the 10-year note, the TNX. Why don't I have that on here? Let me just type it in real quick. TNX.X. This market rallied up to that 200-day moving average and then did back down very aggressively 2-3 weeks ago, and now it's just kind of bouncing around in here. So I think with the yields, we're going to see them maybe begin to stabilize and coil up between the 50 and the 200-day moving average. Anyways, it was a good week to be bullish, and hopefully everyone here participated and did well in their accounts. And have a good weekend. I will talk to you again next week. Thanks.